In section 1.2 today, we are going to be talking about 3 different learning objectives. The first one, we're going to talk about classifying accounts as either assets, liability, and owner's equity. We're going to analyze the effects of transactions and then distinguish between cash and on-account transactions. So finally getting into some transactions here. So it's first important to note that Delgado Web Services is the company that we'll use for all of our examples this semester. So they are a service business. That means that they perform a service for a fee rather than like sell a product, for instance. So some examples of service businesses that you might know that you could get on your note guide would be like lawn care, a hair salon, a car wash. Those would all be examples of service businesses. A proprietorship is a business owned by one person. We've talked about this semester because we will be talking about a proprietorship this semester. Second semester, we'll be talking about a corporation. Well, a proprietorship is a business owned by one person, and this is sometimes referred to as a sole proprietorship. So all these things are really important to define when you start your business. Another thing that's really important when you start a business is to create a business plan. So this is a formal written document. It would talk about what type of business you are, a service business. Are you a proprietorship? Are you a partnership? Are you going to have a storefront, or are you going to sell everything online? So those would be all important things that would be included on a business plan. The standards and rules that accountants have to follow are called generally accepted accounting principles. So this will be referred to as GAAP going forward. But these are the rules that accounts have to follow. So that way we know that any report that you read, an income statement, a balance sheet that we read from our corporation financial analysis, we know that all of those can be comparing apples to apples, because every accountant is following the same rules and standards. So this is really important to ensure that we have consistent reporting. So consistent reporting means that everyone is reporting using the same guidelines. So on your note guide, we have a few different examples of GAAP rules. The first one being GAAP unit of measurement. What unit of measurement does the US use? Well, we use dollars. So you know that if you're looking at a report from a US company, they're reporting in US dollars. The next one, talking about a GAAP business entity on your note guide, means that business owner cannot count his personal boat as a business expense. So you know when you're looking at expenses of a business or the liabilities of a business on the balance sheet, when you're looking at your corporation financial analysis, you know that those don't include personal expenses. So that is really important. Remember from 1-1 that anything of value that is owned by a company is called an asset. So anything of value that is owned is an asset. And assets have value because they can either be used in the business or used to buy things for the business. So that's really important. Now we're going to talk about equities and owner's equity. We talked about assets and liabilities in 1-1. Talk a lot about owner's equity today. When you're thinking of owner's equity, you're thinking the value of the company. So the value of the company, you may have $100,000 in your bank account, but if you owe, so you'd have $100,000 of assets, but if you owe $20,000 in liabilities, the value of your company is really only $80,000. So the owner's equity would be $80,000. That's the value of the company. So that is really important. We know that an amount owed by a business is called a liability. Well, that's going to decrease the value of the company. So the accounting equation, this shows the relationship between assets, liabilities, and owner's equity. And you could write that one of two ways. The first one being owner's equity equals assets minus liabilities, as you see on your note guide. So again, that's owner's equity equals assets minus liabilities, which is exactly how we found out the personal net worth in 1-1. We took the assets minus the liabilities to determine the personal net worth. Another way of writing that is saying assets equals liabilities plus owner's equity. This equation always has to balance. So whatever's on the left-hand side needs to match the right-hand side. So the accounting equation must always be in balance. The total on the left must always equal the total of the right. So now we're going to talk about transactions here and get into our first couple transaction. A transaction is any time that a business owner engages in activity that affects the assets, liability, or owner's equity. So when a business spends or receives money, it engages in business activity. So we will be playing Monopoly at the end of the semester, and every time money exchanges hands, a transaction would need to be recorded. So that is an example of a transaction. Transactions always are organized by account. So we'll have an account called cash. We'd have an account called supplies. Keep track of how much supplies we have. And these are all labeled or given a title, which is called the account title, the name given to an account. It's important to have these so that we can find our account balance. The account balance is really important. Let's say we're just wondering what's the value of our supplies right now? How much do we have in supplies? So we want to know the account balance for the various accounts. Finally, when we're talking about owner's equity, we call this the capital account. So it'd be whoever the owner's name is. So in our example, Michael Delgado is the owner of our company. And it is the capital account. So Michael Delgado Capital is the name of that account to show the value of the company. So we have our first transaction here. We received cash from an owner as an investment for $2,000. So we have $2,000 increase in cash. So we have a cash count. The account title is cash. We're increasing it by $2,000. So the left side has a positive $2,000. The right side, we're increasing the value of the company. Right now, the value of the company is $2,000. So Michael Delgado Capital, he's the owner. This is the capital account, which shows the value of the company, positive $2,000. The left side of the equation equals 2,000. The right side of the equation equals 2,000. They're in balance, so we're good to go. Our next transaction, now we're paying cash for supplies, $165. So if we pay cash, just like when you swipe your debit card and you're using money out of your checking account, when you pay for something, the value of your account goes down. So we are going to decrease our cash, but we're going to increase the value of our supplies account. So just like in math, when you have negative 65 plus a positive 165, those cancel each other out. So we have 0 on the left and 0 on the right. So we're still in balance. So that is that transaction. Our third transaction here, we paid cash for insurance, $900. Okay, so again, we're paying cash. So the value of our cash account is going down. We have a decrease of $9,000. But then the value of our prepaid insurance account is increasing by $900. So those offset each other, 0 on the left and 0 on the right. So if they are on the same side of the accounting equation, one is going to increase. This is on our note guide. If the transaction affects accounts on the same side, one account must be increased and one account must be decreased to keep the equation in balance. And the reason we have an account called prepaid insurance, it's because the insurance premiums are paid before they are used. So we pay monthly and we have an account to keep that $900 in. So it's prepaid. This is important for our last two transactions here to know what a creditor is. A creditor is anyone that a company or a business owes money. So if I buy Starbucks for my friend and I say you could pay me in a week, well, they owe me $5, but they can pay me in a week, then I am a creditor. They owe me money. So we're going to talk about two more transactions that we buy something and then pay for it later. So we bought supplies on account from Canyon Office Supplies. Notice it doesn't say anything about cash. So we bought supplies for $220. We got the supplies, but we're going to pay Canyon Office Supplies later. They are a creditor. So that transaction, we're going to increase the value of our supplies by $220. Also increase the value of our accounts payable - Canyon Office Supplies because we owe them $220. Okay, $220 on the left, $220 on the right. We're in balance. We're good to go. The next transaction is when we are actually paying cash on account to Canyon Office Supplies. So we're paying cash. So we're going to decrease our cash account by 100. So negative 100 on the left. On the right side, negative 100 because we're going to decrease the amount that we owe Canyon Office Supplies by 100. So negative 100 on the left, negative 100 on the right, and we are in balance. So you're going to get some good practice as you watch the next video where we do the work together. And then you all do the on your own application mastery and challenge to get even more practice. So that is section 1-2.